Hi, everyone. A very good afternoon to all of you present on the call today. I am Chirag Joshi, the Chief Growth Officer at Samco Mutual Fund. And on behalf of the whole Samco Mutual Fund team, I would like to thank you for taking out time and attending our first unit holders meeting for the Samco ELSS Tax Saver Fund post NFO. On this call today, I have with me Umeshkumar Mehta, who's the CIO. I have Nirali Bhansali, who's the Equity Fund Manager. I have Dhanani, who is the fund manager. I have Mr. Viraj Gandhi, who is the CEO of Samco Mutual Fund. On this call, Umesh Mehta and team will give an overview of Samco ELSS Tax Saver Fund's portfolio strategy and deployment details. Over to you, Umesh Bhai.
Thank you, and a very warm welcome to each one of you. So currently where the markets are, there is a lot of talk about a bank failure in US, what's going to happen. Markets are down. Panic seems to be gripping on the street. So that's, and how we will be able to, and how will small mid cap perform, etc., etc. So we will talk all those and a little bit more about our strategy, market outlook, how we have deployed, and overall how things are going to look from year after. So first of all, small and mid cap, where they stand and what's the potential, and how do we look them from a 2-year perspective. I think this is what a majority of questions that we have received would like to know. 2 years down the line, 3 years down the line, where would this fund or what kind of return, and how we look at markets and stocks. I think this is one of the major questions, so that I will address. Is it the right time now to invest in small mid caps? What is the broad status of the market? That also I'm going to address. That where are we currently, and what is the future potential? And on stock specific, our fund manager, Ms.Nirali Bhansali, will take you to different set of stocks, the fundamentals, why we have bought, and the overall portfolio that we have created, the percentage of mid and small and sectoral allocation, etc., etc. So before I begin, let's formally begin. So this is our first ELSS Tax Saver Funds meeting, and standard disclaimer that the stocks that we will discuss are for illustration and are not recommendations, and past performance may or may not repeat in future. With the standard mutual fund investments are subject to market risk. So let's begin. So what I'm going to show is, in this chart, is the US markets 20-year data. So Russell's 2000, as you all know, in America, we have this small mid cap index, and top 2000 companies in that category are bunched together and formulated in index. So the point that I'm driving is, whenever there is a reset meaning there is when we have a major bear market bottom. Once we have hit a bottom, during the bottom, valuations, price, everything converges. And once that convergence happens, that bottom is made. Thereafter, when the rally begins, it is a mid and small cap that creates the higher alpha. So over here in March 2003, we have seen major bottom in that decade. So when the rally began in US from March 2003, as you can see from your to your extreme, the orange line is Dow Jones Industrial Average, conglomeration of large companies, and this is your Russell's 2000. So you see massive outperformance that Russell 2000 had given when the bull market really began. And thereafter in 2009, financial crisis 2008-9, this is where the convergence happened. This is where bottom happened. And thereafter, you see a very neat rally, mid and small cap begin their outperformance journey. all throughout the ensuing bull market. So this is how we see mid and small cap as a space that will turn out going forward. So this is, so next, so now let's come back to the March 2020 bottom, COVID bottom. Again, this was the reset point. If you can see my mouse over here, when the rally began, mid and small were slightly better. But in the later part of rally, we have seen a massive outperformance in small and mid cap. And this is where we were. Currently, in US, convergences are happening over here. If you see, now also valuations and price actions and corrections are converging, meaning that this is an attractive time to accumulate. And as I told you, and my few more data points that I will share, once we have this, once this becomes an attractive time, then small and mid caps, as and when the rally begins, I think that will create an alpha, and that's how we the magic of small and mid caps will play thereafter. So this is how things are currently in US. There is little bit of panic currently right now, and we are seeing this convergence as you have seen over here, the arrow mark, and this is where we are. It is possible that for few more weeks there will be some amount of correction or till the time. So I think March 2020, 22nd March, in fact 23rd March will be an important day, wherein according to us, there is going to be a sea change in what Fed speaks, what market was expecting and what Fed will deliver on 23rd March. I think that's going to be a positive surprise. And I think it's going to change the entire sentiment of market. Anyway, let's look at the further data point. Let's look at India. So as you all know, October 21, over here, if you see, Nifty had made a major top sometimes in October 21, last year, 2021. If we see mid and small cap from thereafter, from major tops and major bottoms, I think those are reset points. So mid and small cap space is aligned, or there is no major outperformance that we have seen. That means that the convergence is still there. The valuation gap is still, there is no valuation gap. And when there is no valuation gap, that phase, what we call as accumulation phase, or that phase, what we call as market is fairly priced. And when we enter at that time, when we see bull market unfolding, that's the time the small and mid cap magic really unfolds. So this is where currently we are in terms of Nifty 50 and small cap 250 shares. I think this really broadly captures small cap 250 shares, what the sentiments are, what the mood of the retail investor is. So they are not jubilant and they are not absolutely pessimistic. So they are at a fair to little bit lower, fair to little bit pessimistic moods, and therefore the valuations are attractive. And given what's happening out there in US, by 22nd March, 23rd March, things will be absolutely clear, and we will be able to ask our investors, now is the time for next 3, 4, 5, 6 weeks is a time to accumulate aggressively, and thereafter the numbers will look pretty handsome. So this is where, so this is a major bottom of June 2022 in India. So Nifty in June 2022 had made a major bottom, and thereafter, if you see the fag end pockets of the orange line that you see is mid small cap 250 index. You see the outperformance over here. So that phase of outperformance will come from this small mid cap space. We just have to keep patience, and just we have to accumulate, so that when the bull market magic happens, we will be able to see the outperformance. So why it is going to happen? So this data point tells a lot. So this is US markets 2-year and 10-year bond yield. And the bond market or the interest rate market is one of the biggest market on this planet. And America has a lion's share. So reading this market is very important to understand the future course of stock market. So the top graph, if you see, that's 10-year bond. So 10-year bond, the yield was falling. So that was a sloping line, but the 2-year bond yield, the line was rising. So this typical divergence is absolutely a strong signal that interest rate is going to pivot, and it's going to pivot maybe in this month itself. Things will turn out things will turn out far better for equity market in terms that cost of money will now stagnate, will not rise, because interest rate will not rise. Maybe this is the last hike that if at all we see from the Fed, and from thereafter we are going to see. So because the failure of bank is the biggest shocker to the Fed itself, that they have been massively increasing the interest rate since last 1.5 years by around 4.5-5%. So it is possible that this type of problem could happen in other banks as well. So now they have got a understanding, and I'm sure markets are a bigger learner. Markets are far bigger than even the Fed. And I think market is giving them a clear indication. It's over. No more. We have done. Interest rate peaks are registered. This is it. So this is what we see, and see the massive fall in 2-year bond yield. I think 2-year is the nearest, and this is what even the Fed is going to mirror. See the massive fall in yields from 5% to around 4.3%, 70 bips just in 3 days. I think this really speaks a lot. So if this being in place, when interest rate is not going to rise, then I think it's greater chance that when this bull market, when they rise, small and mid caps will have a better potential. So then again, as I told you, mid cap, small cap shares are retail investor fancy, and it is retail investors who really drive the prices and give that massive. So currently where the mood of the retail investor is, so that gets captured through few of the things that I'm going to now share. See, IPO, number of IPOs is one of the important indicator to know the mood of the market, whether you are in bull market or bear market, or we are in the middle bunch of the market. See, because IPOs sell when there are investors ready to buy. If there are no investors ready to buy, IPOs don't sell, and there are intelligent bunch of merchant bankers who advise the companies that look, now is the time not to go for IPO. So if you see below, in last 6 months, 27 companies lapsed their IPO plans worth 38,000 crores, and this is the January data. If you see next, in February, little rain in IPO desert. So since July 2022, as I told you, was a major bottom in India. You've seen zero amount raised through IPO. Now in January, February, March also, this number is near to zero. Means what? If retail investors are pessimistic, if the sentiment is bad, if that means that gets reflected through IPO activity. So if IPO activity is little, means retail investor activity is less, or they are pessimistic. Third, if retail investor mood is pessimistic, now is the time to ask our investor that now you put in the money, because if you want to get alpha, you will be able to get contra, you will be able to go against the crowd, and you will be able to accumulate shares and units, so that when this again retail investors turn bullish, when the IPO cycle turns bullish, when things look normal, that's the time valuations will be very, very lofty. That's the time not to invest. Now is the time to invest. Probably that is the time to sell when things are much, much better. So this is what we think the current status of the market is. And there's one more data point. This is of February, last 2 weeks before, 38 lakh investors exit. When investors exit, you all have had your experiences. Then when SIPs are cancelled or when investors ask for redemption, so that's the time they ask at or near the market bottoms or when the markets are low, because behaviorally, they are not able to digest when markets are at. So these are the times you have to identify these signals, have courage, and ask and get the money into and in the small and mid cap space. And I think ELSS as a category, the Samco's tax saver fund, I think has a bunch of great stocks that we hold in our portfolio. As Mrs. Nirali Bhansali takes through, you will be convinced that look, we some of the great businesses out there in India. And as India grows, as we enter into the next phase of bull market, all these stocks, underlying portfolio companies will perform better, and they will have great performance. So yeah, pause from my side, and I will hand over to Mrs. Nirali Bhansali to take over the other part of presentation, wherein broadly on our Samco ELSS fund strategy and the details and the portfolio construction she will share. Thank you. Over to Nirali.
Hello, everyone. Firstly, thank you for joining us today on our first ever ELSS meet. So I'm sure everybody would be having a lot of questions. And in fact, we have already gotten a lot of questions in terms of our construction, in terms of the strategy that we are going to follow, etc. So today I'm going to cover all of that and many more details about the fund and our strategy going forward. So firstly, our ELSS fund started in December as an open-ended fund. Before that, we had our NFO where we garnered around 32 crores. And from that date, we have been allocating more and more into equities. So in terms of our portfolio construction, it is still going on. And we are in the process of constructing the portfolio even now. And going forward, yes, in the next few weeks to a couple of months, that's how we plan to finish allocation. And every time there is a dip in the market, there is a correction in some of our stocks, that's when we will continue to keep adding in the portfolio and finish the entire allocation. So that is the thought process behind the portfolio construction of the ELSS fund. And having said that, this meet is going to be all about the construction of the portfolio, the strategy, and also one more factor, which is how we differentiate ourselves from the other 41 ELSS funds out there. So without wasting any time, let me get on with the presentation. Firstly, you see a picture in front of your screen and there's a herd of sheep out there. But if I were to ask you, which is the sheep which provides the most milk, or can you differentiate one sheep from the other? It's very difficult, right? Because all of them look the same and there is literally nothing that differentiates one from the other. So the issue in the ELSS category today is very, very same. Why do I say that? It's because you see this table. In this table, you can see very clearly that there are 41 funds out there in the ELSS category. But within that, largest exposure, so almost 70% composition goes towards large caps. Mid and small caps form a very, very small part of the portfolio of these funds. Over and above that, there is around 1,45,000 crores in equities only in ELSS, and 1 lakh crore goes towards large caps. So that is a very big chunk which goes towards large caps. And SEBI doesn't say that in the ELSS category, you need to have more large caps. But even then, this is the scenario. And this scenario is quite similar to the benchmark index. And benchmark, if you see the Nifty 500, is also 77% exposure, it's to large caps. So mid and small cap again is very, very small. over and above. Now, if you go deeper into this to see what is composing in these large caps, so what is a part of these large caps, you will see that among all the funds out there, they have invested in the same 15 stocks. So the majority exposure, almost 40%, even these funds goes towards the same stocks. So same 15 as in this ICICI Bank, many of them have Axis Bank, they have HDFC Limited, they have SBI, Bharti Airtel, TCS. So if the composition is the same, as in their allocation to market cap is the same, which is large cap, within that also they continue to hold the same percentage of stocks, as in the exposure is very similar, then what happens is that among these ELSS funds, the returns will also be more or less in the same range. And for unit holders, as in for investors now, more so it is important for them to understand that choosing the right fund, investing in the right fund is very essential, because you invest in funds for an alpha, you want the returns. And if everybody is providing the same thing, how will you pick the right fund for yourself? So that's why it is very important to pick the right fund, because returns, what is happening is, if you check the index returns in the last 20, 30 years, they have actually been declining. So these are Sensex returns from 1980 to 2000. Sensex was delivering a CAGR return of 20%. But after that, 2000 to 2010, it reduced to 12% from 20%. From 2010 to 20, it reduced to 9%. And we don't know where this is going to go forward, right? So therefore, it is very important as an investor to choose the correct fund for your portfolio, or to have the correct allocation. And at Samco, we are therefore coming out with a fund which has predominant exposure to mid and small caps. And as I just showed you, the other funds out there, majority of them have an exposure to large caps. And our exposure will be predominantly in mid and small caps. So this would be our the most important differentiation factor that you can say compared to the other ELSS tax saver funds out there. Now, why does this work for us? As in, if you see, ELSS as a category is a 3-year lock-in product. And in these 3 years or more, you check the returns and the risks of mid and small caps. So let's see what happens in terms of returns firstly, when it comes to holding mid and small caps compared to large caps. You take 1 year, 3 year, 10 year, or 15-year returns. You can easily see that Nifty 50, which is a large cap index, has delivered returns, but mid and small cap have given much higher returns than the large cap index. Again, on a calendar year basis, Nifty 50 delivered 15% return, and mid cap and small cap on an average has delivered 22-23% returns. So you see, in any time frame, so there was a 1 year, 3 year, 10 year, I showed you on a calendar year basis. Now let me show you on a rolling return basis. So on a rolling return basis, again, the Nifty mid small cap 400 returned 44%, whereas Nifty 500 delivered 36%. Now let's look at the risks and the volatility. So this is a 1 year CAGR chart in terms of volatility of the mid cap 100 index. In 1 year time horizon, yes, there is very high volatility. There are huge swings that you can see. There is a downside swing, there's an upside swing, there are drawdowns, etc. But what happens is, because this is an ELSS product with a 3-year lock-in, you can see that in 3-year time frame, this volatility drastically reduces. So the portfolio, now this green line is your 3-year CAGR volatility line, whereas the blue line is your 1 year CAGR in terms of volatility. And this volatility is definitely smoothing out on a relative basis compared to the 1 year holding period. So from a 3-year perspective, returns are managed, risks are very well defined. They definitely smoothen out on a relative basis. And therefore, this product that we have made for our investors is a very, very solid combination. So we have a 3-year lock-in product wherein we will predominantly be in mid and small caps, and that will enable our investors to make a potential higher risk-adjusted return in the process. So yes, this was our differentiation factor, which helps us to stand apart from the other 41 funds out there. And this was also one of the that we had got a lot of questions, and this was one of the questions which many people had asked us, that how do we differentiate your product or your fund from the other funds out there, and why should we invest in your fund? So this was basically what we wanted to show in terms of our differentiation factor. Having said that, let's now get into some more details of the fund and our strategy. So we have a very well-defined strategy. It's a simple E3 strategy. It is a 3-step strategy. The first leg is that we buy only efficient Hexashield tested companies. Second is we buy them at an efficient price. And third is we maintain an efficient churn. Coming to the first leg of the strategy, which is we buy only efficient Hexashield tested companies. Now, what do I mean by Hexashield tested? For those who aren't aware, we have an internal framework, which is the Hexashield framework. And this is an algo-driven tool. So we have made this internal technology, algo-driven technology, wherein there are over 2 crore data points that go into the system, and it filters out companies and businesses for us. The heart of this Hexashield framework is nothing but finding businesses who can survive and who can deliver high return on capital employed. Because only when businesses who have a lot of free cash flow, they continue to reinvest in their business again and again, will their growth engine continue. And then only in the future, they will be able to deliver a high return on capital employed. So that is our prime focus in picking stocks or picking businesses for our fund. Having said that, how do we do this? So we have 6 tests that we do. So there are reinvestment and growth tests, wherein we check for growth of these businesses, sustainability or consistency of ROCEs. We see how much they continue to reinvest in their business. And that's how we judge this parameter of reinvestment and growth test for a particular company or a particular stock. We also check for regulatory tests. Now, regulation could be a promoter of growth, or they could be harbingers of growth. So it's very important that the regulation is by your side. So we look for companies or businesses or industries where the regulation is definitely pro-growth rather than hindrance of growth. Competitive tests, whenever there is more competition in a particular industry or a sector, what happens is the existing businesses margins get affected. There shouldn't be low entry barriers, because that means that many new players can enter the industry. So all these factors together is what we see when it comes to the competitive tests. When it comes to corporate governance and leadership, we do check for independence of the board, who is running the business, what is the succession plan, etc. So these are the main factors we see when it comes to corporate governance and leadership. Cash flow tests, here what we do is we check, because cash is king and cash is the heart of any business at the end of the day. So cash is very important. So this EBITDA to free cash flow conversion or EBITDA to CFO conversion, working capital requirements, etc. are checked in the cash flow tests. Balance sheet tests, again, asset liability mismanagement. There shouldn't be a lot of leverage. These are particularly things that we check for in businesses. And what we do here is we put a particular business to 10 levels of degrowth. And after that, we see, does the business survive? Does the business still continue to generate high return on capital employed? And only if a particular business clears each of these 6 tests, will the business or the company clear our Hexashield framework. So we have a very detailed process in place. We have a technology-driven process in place, which helps us to filter and narrow down our universe. After that, it is the mixture of both worlds. So technology we use to filter out stocks. After that, we have our fund management team. We have the research team, which together work together as a team to select stocks for the portfolio. So this is basically what we do is we put 67,000 globally listed companies into this framework. And after that, we have a universe of around 200 plus businesses which have cleared our Hexashield framework. So that's where our universe gets narrowed down, and we select very, very quality Hexashield tested stocks for our portfolio. And that is basically how we have constructed the portfolio till now. However, let me tell you that this is not over yet, because till date we have allocated, as in February end, we have allocated 48% of our AUM, which is in Indian equities, and we hold 51% cash till now. Having said that, we have constructed a robust portfolio of 28 businesses, but we intend to take this to over 30 companies, and could be somewhere, the final number could be somewhere between 30 to 40 businesses that we want to hold in this particular portfolio. So this portfolio construction is an ongoing process, and in the next couple of weeks to maybe a month or more, we would allocate the complete portion of almost 80% and above to these stocks. Having said that, with the portfolio, what we are doing is, with these 28 stocks, we are underwriting 7 different themes. So if you see, we have a very well diversified portfolio till now. We have exposure to technology, finance, consumption, infra, auto. We have some oligopoly businesses, healthcare and pharma, and chemicals. Having said that, these are broad sectors or trends that we are playing. But there are a lot of subsectors or a lot of diversification even in these sectors that we look at, and we don't want a lot of overlap in businesses, or we don't want a lot of exposure in one particular subsector where everybody is doing the same. So even within these, our effort is to have diversification so that we can maintain resiliency in our portfolio even after holding mid and small cap stocks. So let me get into details and tell you in more detail how we are playing each of these trends and what do we expect from these businesses going forward. Coming to the first trend that we are underwriting, which is the technology theme. Now, in the technology theme, we have 4 stocks, but there is a difference in them because the kind of businesses that they do is very, very different. So Coforge and Mphasis, basically they are into the mid-cap IT space, but with the Y2K boom, what happened was there was a big digital transformation. So Coforge and Mphasis are mainly to ride the cloud and the digital trend that is playing out for the future. And they are continuously reinvesting into their business. They are upgrading their systems, and that only helps them deliver the high return on capital employed even in the future. So these are 2 mid-cap stocks that we have. Over and above LTTS. Now, LTTS is in a different space in the IT sector. It's into the engineering, research and development services play. So here, what we are doing is with LTTS, it already services 53 of top 100 R&D spenders. Again, very, very high retained earnings, and they continue to reinvest in their business. That is what is going to help LTTS deliver a high return on capital employed even going forward. With Persistent Systems, it is a software engineering and strategy services player, and it partners with many IT global companies like IBM, Google, Apple, Microsoft, etc. So with these 4 companies, we are trying to underwrite the technology theme and ride the technology wave, which is expected to come in a couple of quarters. Coming to the next theme that we are currently underwriting, which is financialization of savings and lending as a theme. So Aditya Birla Capital and with Poonawalla FinCorp, they are financial services plays where they are into many, many different services oriented in the financial space, but they have a very, very strong brand, very robust asset liability management, strong assets, and all of this will help them deliver a higher net interest margin in the future. So we feel that with these 2 players who have a very strong book and a lot of growing opportunity in terms of the space they are in, they will be able to deliver higher NIMs and higher ROAs going forward. Coming to AU Small Finance Bank, it is the largest small finance bank in terms of market share, and it basically caters to the retail masses. So we feel that with AU Small Finance Bank, it is in a very healthy position because ROEs, ROAs, if you check, are very, very strong. And it is in a different kind of a space. It is a retail focused bank, which is for small finance. So in terms of financial services also, as the financial economy of India continues to grow, these companies will definitely grow and build going forward. So we see a lot of growth potential here when it comes to India's financial economy and growth. Coming to the third sector that we are underwriting is the India consumption theme. So as we continue to spend, consumption increases, and indirectly our GDP also grows. So that's the thought process of underwriting and being bullish on the India consumption theme. We have some FMCG brands that we are holding, which is Procter & Gamble, Colgate, and Imami. Now, these three brands have done what? They have created such strong moats because they have a wide distribution network. They have high intangible value because of these brands that they have built, and that has high stickability or recall value. So an Indian consumer, when you think of a particular brand, which is basically in the female hygiene space, the thought comes that the product is Whisper. Now, that kind of brand stickability is something that PGHH has made for itself. So we feel that holding these brands is very, very essential, because as our market grows, as our population grows, and their reach continues to grow, what happens is the pie grows, and that's how their earnings will also grow. So therefore, we are playing the Indian consumption story with three FMCG players. Coming to QSR companies, which is Jubilant and Devyani, now India is a very under-penetrated market, and these two companies hold franchises in Domino's, KFC, Pizza Hut, which caters to the rural taste of India. And therefore, these two players are also very essential companies, or very essential brands, you can say, which make a huge part of the India consumption story. And that is basically what we are trying to play here, or what we are bullish on going forward. Coming to the Indian infra play and auto ancillaries. Now, to build any kind of a building or infrastructure, what happens is you would require pumps, you would require steel pipes, you would require tubes, you would require steel itself. And all of that is provided by Crompton, APL, Apollo, Grindwell, Norton, Supreme, and RHI Magnesita. So together, these companies, what they do is they provide the essential raw materials that stitch this infra story together. And as you all are aware, a lot of expenditure is being done by the government itself on increasing infrastructure in India. So all these companies will help us play this infra theme that is going to help India develop as an economy going forward. Coming to our auto ancillary exposure, we didn't want to play the typical auto theme by going with a PV vehicle player, etc. What we wanted was, we wanted to get into a secular play, that is, irrespective of how auto demand is, there will always be production from a perspective of a tire manufacturer, because a tire manufacturer, irrespective of the demand, will always provide tires for agriculture, will always provide tires for construction vehicles or commercial vehicles, which are basically used for the construction business. So all these tires are provided by Balkrishna Industries, and therefore it is a secular play rather than it being a very, very cyclical player. So this is what we are trying to play with our India infra and auto ancillary industry exposure. Coming to oligopoly businesses, we have 4 companies in the portfolio, 4 businesses in the portfolio, but they have very strong dominant market share. What happens is there is high entry barriers in each of these particular industries, and because of that, they are free cash flow generating, very asset-light business models. And the best part is they are all leaders in their respective subsectors. So you take MCX, it is the largest commodity trading company, then CDSL, largest security depository, CAMS, largest RTA, or you take CRISIL for that matter, it is the biggest bond rating and research company in India. So with all these 4 players, again, we are playing the India story, because as India continues to grow, all these 4 players will definitely have a huge potential for growth in the future. Healthcare and pharma, again, very important sector. You take Suven, GB Chem, Ajanta. All three of them have niche expertises in their individual segments. So we have a CDMO player with Suven Pharma, JB Chem, it's into therapy and probiotics, whereas Ajanta is into different segments. It is into dermatology, it is into cardiology, pain segments. So with each of them, what we are doing is trying to target different sub-segments, even in the pharma sector. So it's not that we have a lot of replicas, as in everyone is doing the same kind of a business, or everyone will fight for the same kind of a revenue exposure or a target market. It's that each one is in their own space, very comfortable and generating a very high ROCE. With Pfizer, it is a MNC player spread all across the globe. So Pfizer needs no introduction, very strong brand that it has built for itself. In fact, the global technology investments it does, the R&D it does, actually helps India and India as a country, because that's the expertise it uses, that's the intangible value that it has because of the brand that it has built. And therefore, going forward, we feel that with all these companies, they will be able to continue to deliver the high ROCE and the growth potential that we would like for our portfolio. Last but not the least, the chemical sector. Even in the chemical sector, if you see, we have two companies, but they are very different. So Coromandel is into the agri-chemical play, whereas Vinati Organics is into specialty chemicals. So Coromandel is completely different. Vinati Organics are leader in completely different products. So the Vinati Organics is into ATBS, butyl phenol, IBB, etc. Whereas Coromandel is into DAP, other fertilizers, etc. So both are targeting very different markets. They have a very different client base as well. So what we are trying to do is, even in the chemical sector, we don't have exposure to the same stocks or to the same companies, same type of companies. So it is a very, very well diversified portfolio. And this was actually one of the questions that was asked to us, that what is the diversification going to be? So till now, if you see over here, this is our allocation to different stocks and sectors, and we are going to maintain this kind of a diversification even going forward. Having said that, when it comes to market cap, 34% is towards mid cap, 14% is towards small cap currently, and even going forward, we are going to maintain this kind of a ratio where at least almost 60-70% would be mid caps, and over and above that could be small caps. So our thought process is that we are definitely going to have a majority weightage in mid caps going forward, and small caps will be accordingly. So that is our strategy that we want to maintain even going forward. So at a later date as well, you would see a similar kind of a composition in our portfolio. In terms of our active share, actually, it would not be fair to talk about the active share currently, because we do hold cash currently. But having said that, right now our active share is 97%, because we have no common stock with the benchmark in terms of the top 10 constituents. Even going forward, the effort will always be to maintain a high active share, over 90% active share of our portfolio. So this number that you see definitely is a number which will continue to follow in the future as well, when we actually complete our portfolio allocation. Coming to the Hexashield framework. So I explained the Hexashield framework, but let's see with our portfolio what the Hexashield framework looks like. As in, our companies or our 28 businesses have cleared this Hexashield framework. And when I say that, what does that mean? So if you look at the reinvestment and growth stress test, the average you can see of these businesses is over 20%. So that's the kind of growth that these businesses do deliver going forward as well. There is a lot of expectation that this growth is going to continue and multiply going forward. Coming to corporate governance and leadership, on all the tests, it clears. Cash flow tests, one of the parameters is CFO to EBITDA, which is shown here. If you see, the average is still above 40%. Balance sheet and debt stress, one of the parameters again is average debt to equity ratio, wherein you can see very well that the number is very, very minimal and there's not much leverage in these books. Competitive strength and pricing power, EBITDA margin, again, well over 19-20%. So very safe to say that these businesses have cleared the Hexa Shield framework and regulatory test also is cleared. So basically, all our 28 businesses, we have stuck to our strategy till now, and even going forward, we will continue to stick to our strategy of investing in only Hexa Shield tested quality mid and small cap businesses. Even if you look at them from their current results, you will see that compared to the benchmark, they are quality mid and small cap businesses, because if you see the accounting ROC as of FY22, it's 33%, Nifty's was 21%. You see the ROC LTM, 44%, Nifty's was 21%. ROIC, if you take the 5-year average or you take the latest fiscal year, again, much higher than the benchmark. Gross margins, again, almost 57%, whereas our benchmark Nifty 500's gross margin is around 42%. Debt to equity ratio, as I showed you, very, very less, very, very minimal, 0.32. Compared to that, Nifty 500's is around 0.53. Sales growth, PAT growth, much, much higher than Nifty 500. So on all the parameters of fundamentals, yes, we have very well stuck to our strategy, and we will continue to do the same going forward as well. When it comes to financials, again, very different fundamentals that we see, but you can see that compared to the benchmark, they are much higher. So pre-tax ROE is 20%, Nifty 500 is 18%, capital adequacy 30%, Nifty's is 18%. So from a fundamental standpoint, there is no issue at all. And these businesses are quality mid and small cap businesses. Coming to the next part, how do we select the stocks for the portfolio? I mean, what do we see in these businesses which makes them stand apart or makes them deliver this kind of a growth, or they have high intangible value? So what do we see in these businesses? Let me take you all through a couple of case studies from the businesses that we hold in the portfolio, just to give you all an idea what we expect from them in the future, or we expect in terms of an earnings growth perspective from these businesses. So first we look at MCX, which is a part of our portfolio. Now, before going to MCX, let me tell you what happened with NSE. So NSE is the largest exchange that we have in India today. And NSE's evolvement or journey has been very, very remarkable. Now, NSE, there are 3 line items which actually provide revenue to the, so there are 3 source streams, you can say, of revenue for NSE. So first is through cash, second is futures, and third is through options. If you see its cash equity volumes, what's happened is they have tripled in the last 7 years. Their future volumes have more than doubled in the past 7 years. And options has grown remarkably well. There has been an exponential jump. So it has increased by 50x from 2015 to 22. So this is the kind of bullish move or bullish curve that you can see in the charts. And we see something similar playing out with MCX as well. Let me show you how. So over here, MCX, if you see from 2017 only, the options transaction have started. So option turnover actually. So over here in 2018, it was very, very minimal. But you can see by 2022, it has exploded. So 2022, in fact, the options turnover was double that of futures turnover. So that was the kind of growth that it has shown in a very small period of time. And who is stopping MCX to go the NFC way, right? So this is what we expect, that NSE, if NSE can do it with India continuing to grow, India's financial economy being very, very strong, we see a lot of transactions happening even in the commodity exchange, which will entail a larger turnover and a higher ROC for a company like MCX. Coming to the next stock, which is PGHH, which is nothing but Procter & Gamble. Now, I was even when I explained the India consumption story, I was explaining that high stickability of brand or high recall value is very essential. So consumers today, when you talk of Whisper or you talk of Vicks, definitely that is a brand that sticks. If somebody has a cold, the first thought that comes to somebody's mind is Vicks. And similarly with a consumer hygiene product or a female hygiene product. And why is that? It's because of the moat that this business has built for itself. And in Whisper, if you see, it has the highest market share. So you would ask yourself, where will it grow now? It's already the highest market share. But what you don't realize is that the pie is still very, very small. So India as a country is growing. And if you see our number of females per 1,000 males ratio, that was 1991 in 2015-16, and that has grown to 1,020 by 2019-21. And our sex ratio has also increased from 919 to 929 by 2021 again. So there is a lot of potential. There is still a lot of under penetration in this sector, in this space in India overly. So there is potential to increase the pie in itself. And when that happens, these businesses will continue to grow and they will continue to scale up and get more revenue for themselves. Even when it comes to Vicks, PGHS is doing something very different. It has a lot of innovations even in one brand. So if you see, it has Vicks in terms of rub, inhaler, there is pain relief, there is lozenges, there's tablets. So there's a lot of different type which caters to different client base, and which actually caters to different price points. So all of this does fall under the affordable category for a particular consumer, and that's also something PGHS is trying to capture. So with both these brands, it's become it has developed a very strong name for itself, high intangible value, a lot of reach that it has covered in the market. And we feel that going forward, once the pie increases, it's been able to reach to the rural areas in more depth. You can see that PGHH will definitely continue to grow. Coming to the third case study that we have taken for y'all, which is Emami, and it is the forgotten FMCG. Now, even if it is the forgotten FMCG, but its brands are definitely not forgotten, because you have Dermicool, which everybody is aware of. You have BoroPlus, Navratna, Zandu. These are not new brands when it comes to Indian consumers, right? They have been using them in their day-to-day lives. And if you see the brands, they have captured a lot of market leadership in the Indian market. So in terms of balms, fairness creams, there is oils, antiseptic creams, or talcum powders. So Emami is trying a lot to capture a lot of these skincare, etc., kind of products which are used by consumers in their day-to-day lives. And that's why its top three brands have been able to deliver, or the value of his top three brands is 500 crores plus. So with the smaller brands, its strategy is that it will definitely continue to scale up these brands, scale them up to an extent that they also become 500 crore plus. That is as and when the reach increases, as and when they are able to appeal to larger masses. That's when they will be able to scale up and create that value, which we feel that there is a lot of potential because of the type of products or the type of brands that they have already been able to create. So they have a lot of experience by their side. Having said that, despite of all these advantages or this moat that it has built, its stock price or the valuation is very, very minimal. So it is very undervalued. Compared to that, its peers are trading at much higher valuation multiples. So we feel that this catch up in price is definitely pending, because once the price realizes the true potential of its assets, it will definitely run up and catch up with the earnings growth. So with Emami, that's the kind of moat that we see, and that's why we have Emami as a part of our portfolio. Coming to the last case study that I would like to take, which is Vinati Organics. Now, Vinati Organics, definitely a leader in a lot of products. So, as I had said, ATBS, IBB, HP, MTBV, everywhere 65-70% market share. It is a global player. It exports a lot. It is into backward integration, and it has created such a moat for itself, which is hard for any other specialty chemical to beat. So this high barriers to entry kind of a place or segment that Vinati is in is definitely one of its very important moats, which is hard to beat. And therefore, it is a part of our portfolio. So yes, this was all that I wanted to convey about the first leg of the strategy, which is that we buy only efficient Hexashield tested companies. Having said that, we also have a process of looking at the valuation and the price. So that is exactly where the second leg of the strategy comes in, which is we try to buy them at an efficient price. Now, when it comes to valuation, what we do is we don't see the typical valuation always. We see something called as a free cash flow yield. Now, what that means is if you invest 100 rupees in a particular business, now that business generates a 10 rupee free cash flow. But if you increase the investment by 10 times the price to book, which is a 1,000 rupee investment, your free cash flow yield would still be 10%. So that is how we look at a particular business's valuation. And if you see our portfolio's valuation today, it's 2.48%, and the benchmarks is 2.85%, which is hardly a 0.37%, which is a premium. But this premium is justified. Why? Because I showed you that these businesses are very, very quality businesses, lot of brand, lot of earnings potential that we see in these businesses going forward. And you always pay a price for quality. How do you look at that is you see these bonds, you check the bond market, how it works is for quality, there is a lower cost of capital. But as the quality declines, you pay a higher cost of capital. So even in equity, you should look at businesses in that manner because there is always a justified price or a justified valuation that you pay for a particular business, and it's not always the same. So everything cannot be put under the same bucket. If something is definitely growing, delivering a high earnings potential, delivering everything to the mark, then the justified valuation is exactly what you pay for it, right? So that is how we look at a particular business's valuation. Coming to PE ratios, even if you see them on a PE perspective, for all our businesses that we currently hold in the portfolio, the average PE is less than the 3-year average PE. So the current PE is less than the 3-year average. So therefore, even from a PE perspective, it's not that we are entering businesses at a very, very high PE ratio. In fact, at every stage, we are monitoring and checking the valuation, and that's when we enter a particular business. So our entry strategy is very simple. Yes, we do look for justified valuation, as I already explained. We look for strong relative performance. Quality plays a very big part. So Hexashield tested is something that we check for. We continuously look for Hexashield tested businesses and new opportunities. And we also look for high compounding ability. So these are our 4 factors which form a part of our entry strategy in a particular business. And that's how also going forward, we will continue to add more stocks over and above these 28 businesses that we have in the portfolio. Now, we have already bought Hexashield tested quality businesses. We are paying a justified valuation or a price for it. So the churn would also be very, very minimal. It's not that we are going to continuously churn the portfolio. If the business is growing, since we have bought it at a very attractive valuation, we don't see a particular need to continuously maintain turnover in the portfolio. So we have a very well-defined exit strategy in place as well. So firstly, it has to fail the Hexashield framework. That would be one of the parameters. If we find a better compounding opportunity, why not? We will definitely continuously look for new stocks. And if there is a better compounding opportunity in the universe, we might change it for the existing business. Over here in the ELSS fund also, there is a 10% ceiling that one particular stock can have. So if the exposure in one particular stock goes above 10%, we will have to bring that down. We will also let our mid caps run and become large caps and mega caps. But if this reach a stage of maturity where it's not that the earnings growth engine is going to go onwards, that's when we can also remove a particular stock from the portfolio. So that would also be one of the parameters. And relative underperformance in terms of price. So these are the basic things that we would see in terms of exiting a particular stock from the portfolio or in terms of turnover. So yes, with this, we kind of have covered all the three legs of the strategy. But even when it comes to liquidity, there is no issue at all, because they are mid and small cap businesses, but it's not that they are very, very illiquid businesses. So if you see on an overall portfolio basis, we can completely liquidate the portfolio in one single day. So it's not that we are taking risky bets even in mid and small caps. We are being very, very cautious in the kind of businesses that we invest in. And we're looking for quality businesses and not really putting in money in any small cap or any mid cap that we see out there. So liquidity is also not a concern, and investors' risks are definitely very important to us. And that is something which is of our prime priority. So we keep looking at these risks, and liquidity is one of the factors that we consider. So having said that, just to summarize, our ELSS portfolio going forward would finally have 30 to 40 stocks. Currently, there are 28 stocks. There will be no compromise on quality. It will be a Hexashield tested framework, even when it comes to mid and small cap businesses. So predominant exposure will always be mid and small cap in the ELSS portfolio. We will continue to actively monitor this fund and continue to see the different stocks and exposures, sectoral exposures that we have. And we will also continue to hold our winners. So having said that, this was all about our strategy and portfolio construction. But now, as I just explained at the start of the presentation, that why Samco's fund is different, let me reiterate. Samco is definitely going to be predominantly in mid and small cap businesses. So that differentiates us from the other 41 funds out there. And having said that, returns is something which is higher with mid and small caps. But because this is a 3-year lock-in product, volatility and risks are very well managed. So this is what differentiates us, and which is also one of the benefits or the prime benefits of our fund. Having said that, our endeavor is always going to be that for any investor who invests in us in a 3-year time frame, we deliver the highest risk-adjusted returns that we can. So that is our endeavor. And having said that, this was all that I wanted to convey in terms of our fund strategy, in terms of our portfolio, and what we look for in our businesses in the fund. If anybody has any questions, then Chirag, let's get on with the Q&A. Thank you, everyone.
Thank you so much, Nirali and Umesh, for such an insightful presentation. We have a lot of questions flowing in. I will take them one by one. In the interest of time, we can straightforward jump to those questions. One question, Umesh bhai, for you we have is that, can you please elaborate the efficient, the E3 strategy, and what do you mean by buying stocks at an efficient price?
Yeah. See, when there is quality available in terms of businesses, then we decide is the price or is the valuation justified for the businesses that we want to buy. So for example, let me share certain example. Vinati we have bought. So Vinati, since last 3-4 quarters, on a like-to-like basis, and when I'm talking Vinati, I have in my mind even Atul. So they both are in respective chemical space. But if you see Atul, no, it is possible that if there is an quarterly earnings decline, is it possible that the decline can continue? And given the valuation, assuming valuations currently are equal, but on one hand, there is company who is growing the earnings, who has a earnings engine going on. The earnings are growing quarter after quarter. Another business, valuations are same, but probably we don't know whether the earnings will grow. The current trajectory since last 3, 4, 5, 6 quarters is declining. So therefore, when we are putting our investors' money, we want to be doubly sure that look, China one plus what if China comes with vengeance and if they are able to flood the market, the company whose quarterly earnings was declining can decline more compared to a company, even valuation wise, if both are equal. But let's get into the growth, because see, ultimately we want to invest in growth oriented companies. Then only our investors portfolio will compound and grow,
Correct.
rather than just going for uh, 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 from a valuation perspective. So this is where we have to be very careful in terms of assessing, and free cash flow yield. We have to adjust and understand, hey, from a cash flow basis, are we not paying too high a price, or given the cash flow that we are going to get for our shareholders, is it so minuscule that the valuations are either too expensive that like there is no margin of there is a lot of errors. If they can go wrong, I think their balance sheet can go topsy-turvy. So this is what we do in terms of what is an efficient price. So efficient price, there are multiple things: free cash yield, valuation, your traditional valuation methods, everything we put together, and then wait that where is the growth engine that is faster. That's how we invest.
Got it. Thank you, Umesh. This was a question from Mr. Murli. Now I have one more question from Mr. Zubin. He wants to know what valuation matrix are used for the above listed company, and whether you would be looking to invest in any micro cap companies if they pass the Hexa Shield test.
See, micro, obviously our space is mid and small. But if any micro company is passing and someday it will pass, so we are not that no, we will not invest in micro cap. If the company has the growth potential, we may have a smaller percentage in terms of our AUM, but we will still own that company if that offers potential. Whether it is micro or small will not make any difference.
Okay. We have a lot of questions. I'll club those questions. And I think most of the investors and partners want to know that we have, I think, 50% plus cash in the scheme. So when will you deploy these funds, or why there is high amount of cash in the scheme? I think there are a couple of 6 or 7 questions. So we can club them and answer as one question.
Yeah. So given that we are in the corrective phase of market, and given the global geopolitics and all those things that are happening, so we are cautious, but we are also keeping our eyes and mind open that, look, these are the times we need to keep our minds open and understand if there is an opportunity, we should accumulate. So we have accumulated up to around 50%. And soon market will offer opportunities to deploy further, and this is what we are in accumulation zone. And even from an investor's perspective, I think next 1-2 quarters are very interesting in terms of those who have money. Even from a lump sum perspective, markets are attractive because sentiment wise we are below the average. So this is where we think this makes sense. So yeah, I think these are great times to accumulate, and having a stock specific approach will help a lot, and especially in mid and small cap space. I think there are great things that great companies that we will be able to buy, and we have bought a few, and few more names we will soon once we buy those names.
Thank you, Mr. Umesh. There's
Just
one.
to add, Chirag,
Yeah,
to that
yeah,
same
Nirali.
question. So from a compliance perspective as well, there is no issue. What SEBI tells us is that we have to act in the best interest of a unit holder or an investor. So at any time, as Umesh Mehta explained, we are definitely looking for opportunities to add and accumulate. And from a deadline perspective, because there have been many questions in terms of what is the deadline. So we do not really have a deadline, and it is the best interest that we feel it's is for a unit holder or for an investor, and that's what we will continuously keep looking for, and that's how we will continue to finish the allocation in the portfolio.
Thank you so much, Nirali. There is one question on CDSL by Mr. Jaideep Haridas. He had sent us this question over email. He wants to know that I think most of your fund has an exposure to CDSL stock, and it has seen slight underperformance. So if you could throw some light on CDSL as a stock. Dhawal, would you like to take this question?
I'll take this up. So thank you so much, Jaideep ji, for your question. So, CDSL, being the largest securities depository in terms of number of demat accounts in India. So it has close to around 70 odd % of market share in India. And it is a classic business of royalty on the growth of others. So that is, because the capital markets in India is booming, it is the royalty on the growth of those, booming capital markets in India, just like CAMS. And it is still a small cap company. Now, if you see, since 2014, it has been able to garner the highest share of incremental growth in demat accounts in India because of certain unique features which CDSL has. So firstly, they have centralized server, vis-a-vis setting up on-premise server, which its competitors have. It has a tariff-based slab system rather than giving a fixed rate structure. And of course the requirement, which is close to around 50 lakh, which is half of what the largest only competitor is giving. So it is a high quality business which requires minimal capital to run its operation. Even the additional capital which is required is quite low, and that is why it has a return on capital employed, which is the heart of Hexashield framework, of close to around 41% with zero debt. And of course, given the share price is corrected close to around 45% from its all-time high, the valuation seems quite very attractive to us. So yeah, that's for CDSL.
Thank you, Dhawal. We have one question for Umeshkumar Mehta is, will we get tax benefit in ELSS scheme in the new tax regime?
Now, if you go for new tax regime, there as such no deductions are allowed. It's flat. You pay whatever income is there, you pay a flat tax. No deductions of ELSS, pension, or your other tax benefit that we have, your housing loans and etc. So nothing. So to that extent, yeah, ELSS as a tax saver advantage will move out for that person.
One question there's no name, there are only initials, but he wants to know that how much return can we expect from the scheme at the end of 3 years? Umesh, I would like to take that up.
Yeah, so currently where we are, so if we go back to EMOC that we have built, and I think EMOC is in very ideally, everyone should look at EMOC, at least to have understand the broader perspective of market. Provided there is no black swan event, currently the war is going on and we don't know. But if this war breaks out to a catastrophic event, then the things would be different. But by and large, that's not going to happen, given that America is going for election next year. So there will be a measured response. And I think this war will become a non-event, going forward. People will even forget that there is war going on, and our markets will be into full stream, in terms of our own economic dynamics.
There's one more question where Mr. Rajiv wants to know our view on the impact on the current market of failure of Silicon Valley Bank, and how that can impact the Indian markets.
So I think Silicon Valley Bank failure, as I told you, a week or so, I think by 23rd March, we will have a lot of clarity. So it's just a matter of time. But that is one small bang in trillions of dollars of this economy, this world global economy, will not actually make a difference. But sentimentally, yes, people are talking, people are fearful. But in reality, from entire scheme of things, that is just a small dot, which we should not worry. Whether this will snowball into a bigger thing, that is what we have to watch, and less a week or so or 10 days or so, I think we will get clarity. If nothing happens, and if Fed actually understands that, look, no, now I'm going to slow down, I'm going to calm down, I'm not going to, so I will have keep a pause, and I think things will turn better. And I think that cascading effect will not happen. See, but India is robust. Your interest rate increase was 200 or 250 bips. America, we had 500 bips increase in interest rate. So this sort of risk was about to happen, and smaller banks, I think this is what it had happened. So asset liability mismatch. So in India, the chances are very less, and spillover effect can be sentimental, but not tangible or real. So I think that is where this offers an opportunity for us in India to get into the pedal and pull the trigger, during these times.
We, Nilima, has appreciated the presentation and the portfolio strategy. So thank you so much, V. Nilima. There is one last question. A gentleman wants to know that MCX option volumes are increasing. So is there any specific cause for such a spike? Should we be worried or excited? And I think he is excited and worried at the same time. So if you could throw some light on the MCX increase in volume of option volumes.
See, world over, commodities are an important instruments wherein investors or speculators want to bet on. Unfortunately, in India, commodity market have not grown to that extent. But I think MCX, by launching various options in all these commodities, crude oil, gold, and others that are in pipeline, I think they are doing a phenomenal job, and they have understood that, look, if on equity side, people are, 90% of the volumes are happening on options, then it is every likelihood that in commodities also, when people want to bet, they will bet on options. And I think commodities are, in fact, the logic of MCX is what? See, in equities, there can be manipulation. A company itself can, try and pull a buyback if the prices are falling. But a gold is a dead commodity. Gold itself cannot do anything. So if you want to bet on gold, it's purely on merit, it's purely on demand supply. So people who understand that, I think will move towards even commodities. And I think options are a great way to bet on the directions, and MCX should able to get the kind of growth that we are expecting. I think it offers promising opportunity.
Thank you so much. One last question we'll take, which is a follow-up question by Mr. Rajiv. He's worried that this bank failure looks like a 2008 crash. I mean, do we have any view that it'll be that bad like 2008?
See, 2008 and number one, the current bank failure was because I have deposits. Those deposits are low yielding deposit. And at the same time, I have given on lending, and the lending was also a little bit markup. Therefore, current lending portfolio is also low yielding. But interest rates have increased. So because interest rates have increased, there is a fall in my value of my bonds. So I have to do mark to markup. So when I do mark to markup, that is not allowed. And in America, if you are holding, you don't have to do mark to markup. You can keep on at your book value. But the problem is what? These deposits that we have, that investors or the depositors said, give me my money back because I'm a Silicon Valley or I'm a startup and I want my money back. So they had to pay back. When they had to pay back, and this money is lended for 1, 2, 3 year long term. So this money they cannot get, but they have to give back this money. So that is where the problem arose. And therefore, the scheme that the Federal Reserve has said that, look, we will give you a buffer of 1 year. If all this money that you don't receive in 1 year, 2 year, 3 year, it's fine, because obviously you have lended for 2, 3 years. But this money, if people are demanding, what you do is you can give us this securities as loan. We will give you money for 1 year so that you can pay back. So once you pay back the depositors, that's the time this asset liability mismatch does not happen. And when this does not happen, people will have trust in banks. So this happened because America, there was massive increase in interest rate. Because of this is a side effect. But now when they have understood this, and this weekend, the top brass of America, they have applied that mind, that effect we will only come to know on 22nd or 23rd of March. So to that extent, we have to wait. But I think those guys are sensible. They have understood what they have done. And I think they are going to change that stand, or if not change that stand, I think they will give a forward look ahead. So that's going to play a calm in the market. So this is not a larger risk that we had seen during Lehman Brothers crisis. You know, all those mortgage debt securities were packaged and sold to investors without knowing the risk, and then suddenly this entire systemic crash happened. So currently they have identified the gap, and I'm sure they should be able to plug the loophole. Plug the not loophole, but plug this systemic risk.
Thank you, Umesh. Thank you so much, Vishal, for your kind words in the Q&A section. I think we've taken all the questions, and a lot of questions in the Q&A section that our CEO Viraj has already answered. And I've clubbed a couple of questions which were same. And I think we've taken up almost 99% of the questions that came in. Thank you so much for taking out time today for this presentation. And on behalf of the whole Samco team, I'll wish you a good evening and thank you so much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.